Well, grain starting off the week lower. Arlan Suderman is back with analysis, and it felt like a risk-off day on Monday with that implosion in the crude oil market kind of spilling over into the grains, didn't it, Arlan?
Yeah, it really was. We found out just how much war risk premium was still in the crude oil market. Demand out of China is soft. Worries about the longer-term demand and turning their economy around continued to be a concern for oil traders. And so when Israel struck at Iran to retaliate for Iran's attack on it earlier in the month, and they focused on military targets, leaving alone their energy and nuclear sites, that really eased concerns of the marketplace for now, and they gapped lower, and that created some of those headwinds. But overall, we've got a lot of factors that are kind of creating seasonal pressures in corn and soybeans. Even though we've had good demand of late, we still have to get a home for the rest of this year's crops. And we've also had some good rains in South America, both Brazil and Argentina. We're making good planting progress in Brazil now, still lagging the typical pace, but on pace to grow a good soybean crop there. Our concerns are more going to be with the winter corn crop, because it'll certainly be planted late, it looks like now. That will increase its risks, although it doesn't at this point guarantee that we'll have a short crop.
So with planting picking back up there in South America and some better rains, are soybeans vulnerable at this point? Because could we have that record soybean crop out of Brazil that's being forecasted?
Yeah, absolutely. Our current estimate is at 165 million metric tons based on our customer survey, but we're the lowest of the estimates out there. Most of them are around 168 to 170 million metric tons. I've seen one as high as 172 million metric tons. So that potential is still there, and every extra million metric tons that they plant is one less that we're able to export, because frankly, with currency exchange rates being what they are, Brazil's going to sell their soybeans, and then we'll get the rest of the business after Brazil and Argentina have sold theirs.
Do you think corn is less vulnerable just because we have had that better underlying demand, both export and domestically?
Yeah, I do. And when you look at marketing year-to-date commitments, sales commitments on the export market, corn, those sales exceed the seasonal pace needed to hit USDA's target by 125 million bushels, while with soybeans, they fall short of the pace by 100 million bushels right now. And right now, we're having strong soybean shipments, but we can't sustain that pace if we don't see an increase in commitments. And I think the weaker commitments are a result of expectations that Brazil's going to grow a big crop. And that's why I think the commitments are slow, and it'll shift that way. On the other hand, we're seeing Argentina cut back on its corn acreage by 20 plus or minus %. We saw a smaller crop out of the Black Sea region. All these factors come together, and the fact that Brazil's winter crop, safrinha crop, is going to get planted late, increasing risk with it. All those factors work together to suggest that we could see even stronger corn demand down the road, as we're also expecting stronger wheat demand. So wheat and corn, I think, will feed on each other. That's not a story for now that's going to enable you to sustain a rally now, but it does provide underlying support underneath the market, where soybeans don't really have that story to do that.
So Arlan, how far do you go down here before you start to see that demand pick up and support prices on especially corn and soybeans, though?
Well, I think with corn and wheat, we're going to see some underlying support because of longer-term expectations for better fundamentals in the last half of the marketing year. For soybeans, I'm not convinced that the bottom is in this market yet because of big crop in Brazil coming.
So we talked about some technical selling pressure in the wheat market, but is that market also maybe taking out a little bit of weather premium? We do have some better rain forecasts, I think, for the Southern Plains, right?
Yeah, and we've had some showers in dry areas of the Black Sea region as well. We did not solve the drought in that region. And at this point, we can't say we're solving the drought in the plains, although we'll have to see how these rains over the next week to 10 days do kind of play out. And certainly we hope we do get the rains, but I think it's premature to say that we've solved those problems. But the primary factor I think the wheat market's going to watch is going to be Russia, Ukraine, the Black Sea ability to produce a crop after having a short crop this last year. That's what sets the world cash wheat price. We have ample supplies of wheat in this country. What we need is a short crop there so that they restrict exports, so that the rest of the world has to come, because major exporter supplies are not that big at all. In fact, they're historically at tight levels as a percent of annual usage if Russia starts seeing restrictions of exports.
Well, and Russia has hinted at export restrictions, but it's all lip service so far, right?
Yeah, exactly right. They set a price of $250 per metric ton, but yet exporters have been offering wheat below that level, and there's ways to work around that. And when it comes down to, we feel like they're going to have to start restricting exports one way or the other, probably in the last half of the marketing year. But so far they're not. So therefore the market's holding support levels on the expectation, but there's nothing to rally on until they actually do it.
Let's also talk about the election coming up here. Talk of tariffs, talk of a trade war. Is the market sensing that? Is it concerned? Is it trying to price it in at all?
I don't really agree with those statements that it is. I know a lot, I see that rhetoric a lot in the market, so that's a factor. If you look at the strong export pace we're having for corn right now, it's largely due to business we're doing with Mexico. They did the same thing last year, and it wasn't an election year last year. If you look at the soybean shipments we're doing now that are strong, that's very seasonal, very typical, but commitments are slow. So we ask Chinese buyers, why are you so slow in extending commitments? And they say, well, we don't want to affect the elections, so we're just going hand to mouth right now. And in reality, they're going slower than the normal pace. So I guess you can interpret some into that as far as their choice or whatever. But the bottom line is their policy for quite some time has been to buy all you can from South America and then the rest buy from the United States. And as South America continues to expand production, that means less and less from the United States. And you can say it's geopolitical, and you can make a good argument for that, but you also have to realize that they're value buyers. And so if South American beans are cheaper, which they typically are if they have supplies because of currency exchange rates, then that's what they're going to buy.
What about the funds right now? The Commitment of Traders report looks like the funds are wanting to maybe reestablish that short position. How short will they go, do you think?
Yeah, on soybeans, that's sort of, they're starting to rebuild those short positions. And so that says that they do see risk to the downside, or they might look at it as opportunity to the downside, yet new lows. And they'll chase things as far as they can in that direction if we give away those old lows set back in August. Corn, we're seeing a little different dynamic where they've actually started to build some ownership there, some length. And we've quit the short covering. So there's still some short positions in there, but there's some other funds that are coming in and building some ownership. So it's a little bit more of a mixed picture in corn, giving a little bit more positive outlook.
And the cattle market, we've had a nice run. We had some very strong cash trade last week, a lot of 190 paid. Do you think this market, which is running up into chart resistance, can keep going here? I mean, we didn't get anything wildly negative in the cattle and feed report anyways.
Yeah, I think there's a couple of things that give me some optimism. And this is a time when we might typically struggle, but yet cash prices continue to slowly creep higher. And right now, I don't see anything necessarily to change that. And one of those things is the consumer continues to buy. And when you look at recent consumer sentiment surveys, particularly since the Fed cut interest rates by 50 basis points back in September, that consumer sentiment is starting to creep higher, inch higher as well. And one of the biggest risks to the cattle market had been if the consumer just said, I'm worried about the future, so therefore I'm not going to spend money in the higher cuts of meat, as well as other higher ticket items as well. So the consumer seems to be sticking with us, and that's one of the positives overall. And the other thing is we still do have tight supplies. Now, working against us is the fact that imports have been so strong, and that we're taking these animals to higher carcass weights, record high carcass weights overall. So the total supply of beef is at very high levels right now because of large, heavy carcasses and high imports. But the production of domestic beef overall, as far as the numbers of animals, are very small.
All right. Thanks so much. As always, Arlan Suderman with StoneX. That is Markets Now.